Assalamualaikum and salam sejahtera. This is topic 2, Introduction to Concepts and Convention of Accounting. There are 8 accounting concepts and convention altogether that we need to cover in topic 2. At the end of this topic, the student should be able to explain each concept and relate them to the business situation. Before I proceed with the explanation of each concept and conventions, let's look at what does it mean by concept, assumptions, and convention. Accounting principles or concepts are rules that must be followed in the preparation of financial statement to ensure objectivity. To ensure objectivity of financial statement, it means that the financial statement that we prepare must be free from error, free from omission, and free from bias. Conventions or assumptions are basically the general understanding or generally accepted ideas about the preparation of financial statements. Accounting base or bases are important principles to help the recording process. It helps to guide us to record the transaction, as how to record the transaction and how much to record the transaction. Policies. The policies here are referring to the accounting policies adopted by the business related to the accounting method or basis and the consistent application of that method or basis. So here are the basic accounting concepts and convention: business or economic entity, going concern, monetary units, periodicity, accrual basis, materiality, neutrality, comparability, and cost concept. Let's look at the first one, business or economic entity. In this concept, it is stated that the business is separate and distinct from its owner. Therefore, the items recorded in business books are limited to the transactions that affect the business only, whereas the owner's personal transactions are to be excluded from the business book. For example, electricity bills of owner's house is not to be included in the books of the business. Going concern. Going concern assumes that a business to have indefinite life or to operate for a foreseeable future. In a simple words, we assume that business is going to operate forever. This assumption is important because if we assume that the business is going to shut down by the next year, then we have to change the way we prepare the financial statement. If it is not, then we are going to prepare financial statement as usual. Monetary measurement concept. Based on this concept, the business transaction that can be measured in ringgit Malaysia will be recorded and reported in the financial statements. And then we have to assume that the purchasing power of ringgit Malaysia does not change throughout the years. This is especially important when you make a comparison between two different years of the financial statements. The reason why we are using monetary term because it is a common denominator for every business transaction that happens worldwide. And it serves as an appropriate basis for accounting measurement and analysis. The next one is periodicity. We have to assume that even though the business is assumed to operate forever or for a foreseeable future, we have to assume that the business activities can be divided into regular time period. We have to set the start date and the end date for the business, normally yearly or equal to 12 months. This is to enable comparison and analysis of business financial performance and position. Accrual concept. In accounting, accrual concept is the most important concept because by having this concept, accrual concept, we are able to identify the business performance. Under accrual concept, expenses are recorded when they are incurred. Similarly, for revenues are recorded when it is earned. Regardless of cash payments are made or not, regardless of cash receipt are received or not. Meaning that whenever the transaction happen, whenever the transaction incurred, for that accounting period, everything must be recorded and reported even though you did not make the payment yet, you did not receive the cash yet. Let's say for example, you open your business on 1st January every year and you close the business on 31st December. Alright? So let's say for example, electricity bill for December only to be received in January next year. But because that electricity bill is for the electricity that we use for the month of December, we have to adjust our financial statement and include the amount of that electricity bill. Another example for revenue. On 31st December, you made sales to your regular customer and your regular customer asked to delay the payment and only made the payment to you by next week, which already falls into the month of January. Even though the customer will only pay in January, but you have to record the revenue or the sales that you have made on 31st December. That's what it meant by accrual basis. Alright? Okay, so the next one, materiality. Materiality is where the business transactions are considered material if they have significant or they have important effect on the net income or on the decision making. The materiality, however, depends on the circumstances surrounding the business transaction. It could be the size of the business, it could be the level of sales of the business, it could be the level of profits of the business. The materiality will be differ from one business to another. What does it mean by material business transaction? Material business transaction, in other words, is important business transaction. That if you forgot to report the transaction, it can alter the decision making of the financial statements user. Alright, let's look at the next one. The next one is neutrality concept. Under neutrality concept, we must make sure that the information that we reported in the financial statements are free from bias, free from error, free from omission. This is to ensure that the financial statements that we prepare are reliable. People can trust our financial statement for them to make decision. If the financial statements are prepared to influence the judgment or the decision of the users, it will lose its neutrality. Therefore, when you prepare the financial statement, you must make sure its objectivity. You must make sure that the preparation is not biased to a certain people only. The next one is comparability. The financial statements that we prepare also, we must make sure that it is comparable, meaning that we can put side by side with the other entities business, with the other entities financial statement, but still we can compare the financial statement easily because of the way we prepare the financial statement are similar from one financial statement to another financial statement. We must make sure that the financial statements that we prepare are comparable through times to identify trends and also are comparable with other business organization in case we need to evaluate the standing of our business. Finally, we have come to the last one, which is historical cost or cost concept. Under this concept, all assets, services, liabilities, basically all the business transactions that have happened or incurred are to be recorded at cost. Why we are using cost to record and report the business transaction? Because they are definite, determinable, provide objectivity. However, the cost is not necessarily a cash. It can be cash equivalent, which is equal to the present value of future costs. That's all for topic 2. Thank you.